So we're going to do chapter 9 from the managerial accounting book, and this is on master budget. And of course, I am Professor Viersen, and I've walked you through the first 8 chapters. Now we're going to look at chapter 9, which has to do with the master budget. Now, let me just say up front that budgets are basically the most important managing tool for accountants and business overall, as far as that goes. Budgets can determine if you get a bonus, the job evaluation that you get. They basically set up the entire year. So in some ways, it's hard to live with budgets, but you can't live without them. Okay, and I know from personal experience that not everybody's thrilled to learn about budgets, but once they get into a job, what's on the budget becomes extremely important dealing with their job itself. So, how are budgets used? Well, basically, they develop strategy. That's the beginning of it. You have to have a starting place. And so they begin strategy, and typically upper management will develop that strategy. And that strategy then becomes a plan called a budget. So, as we talked about before, managers plan, control, and so the next stage is here that they act on the budget, okay? And then the budgets are used to control through what's called performance reports, which we'll look at in the next chapter. And then, of course, you give feedback and you compare what did you plan against what actually happened. And then you can make adjustments and you start all over again with a new strategy and a new budget. So basically, how are they developed? Well, there's a number of ways of developing budgets. Uh, because budgets are a company's overall mission or purpose statement, they will always have at least one long-term strategic goal budget. Okay, and that'll be the long-term budget, and that can go out either 5 to 10 years into the future. What we primarily look at here is a 1-year budget or 2 or 3, but all companies will have long-term goals that stretch out into the 5 or 10-year period. When we're designing a budget to attain certain goals, though, we're looking at short-term budgets. You could have something like a rolling budget, where it's continuously updated. So the next 12 months of operations are always budgeted. So that would be like if we have a February to February budget, and then February gets finished, and then we have a March to March budget. So you're always rolling forward on the budget. There's something called participative budget, sorry about that. And that's a question of who's involved. And that type of budget has many levels of management involved, including the lower level managers. So when we initially talked about budgets, we were talking about upper management, but the lower level managers, they're closer to the action. So it would be really good if you can afford it. And there's always a cost benefit analysis that goes into these things. But if you can allow the lower level managers who are close to the action to say, that's highly, that helps. Plus, it motivates those people who are held to account from the budget to work maybe harder to obtain the budget. You're the one that said you're going to be able to produce a certain amount and you needed a certain amount of materials. So you're motivated to accomplish the budget. Now, participative budgets are more complex, they're more time consuming, and sometimes when you get to participate in them, you might just build a little slack into the budget, which means that if you're allowed to, you give yourself a little leeway, maybe a little extra revenue here, maybe a little bit of extra costs, you're just kind of looking out for yourself. But in the long run, there will be a budget committee for a larger corporation that's going to sit down and do the budget. So what is the starting point for these budgets? Well, most of the time it'll be the prior year budget that they look at or the actual results that happen. And then you'll modify that by looking at, well, new products, customers, geographical areas. In other words, if you're expanding the business or contracting the business, you'll want to reflect that in the prior year budget or actual results. Marketplace changes, labor or material changes, inflation, and of course, if you have any new strategies. Now, there's something called zero-based budgeting, where managers begin with a zero budget and they justify every dollar. In other words, they don't start with last year's budget, but they begin all over with each new budget. Okay, so the benefits, obviously the budgets will force the managers to plan. In other words, they can't just kind of have a moving goalpost. They actually have to put forth a plan. It does promote coordination and communication. In other words, now you have something that's written down. You can look at it. You can see where they want you to go. And very importantly, they create a benchmark that will motivate the employees. In other words, if you're trying to cut costs and you're able to reach that benchmark, that motivates you. And it'll help with performance evaluations that we'll see in the next couple of chapters. Now, primarily in this chapter, chapter 9, we are looking at what is called a master budget. It's a comprehensive planning document for the entire organization. And typically speaking, master budgets are used for manufacturing firms. It's a series of supporting budgets. And the two primary areas will be the operating budgets, which deal with the daily operations of a business, which will culminate in a budgeted income statement. And the other half of the master budget is the financial budgets, and that culminates in a balance sheet budget. So we're breaking up the master budget into two parts, operating budgets and financial budgets. Now, in the operating budgets and the financial budgets, but primarily the operating budgets, it does go in a specific order. And it always starts off with a sales budget. And the sales budget you spend a lot of time on it, because if you get the sales budget wrong, everything else that follows will also be wrong. Now, once you've anticipated or budgeted for the amount of sales, now you know how much production you're going to have. So the units that you're selling, you must produce. Well, in order to produce things, you have to budget for the materials, the labor, and the manufacturing overhead that's going to be used in the production budget. From here, we're going to go to the operating expense budget. Then we'll make up the budgeted income statement. And then from the budgeted income statement, we can do the financial budgets. Okay, so these were the operating budgets over here that culminated into the income statement. And now from the budgeted income statement, we can budget for capital expenditures. We can do cash budgets. We can do a balance sheet, and those will all be the financial budgets. All right, so first off, you have a sales budget, and it's very simple. Number of units you anticipate selling times the sales price gives your total sales revenue. So in this case, we're going to be selling cases of Tucson tortillas, And we're anticipating that we're going to sell 30,000 cases. This is probably a monthly budget at $20 a case. So the total amount we're going to sell of Tucson tortilla shell cases is $600,000. Okay, so you can see that was our January projection. Okay, and that's the number of cases times the price per case. And then we can take a look and break this up into how much will be cash sales, how much will be credit sales. And so for January, we have 600,000, February 400,000, March 500,000. And so for the quarter, we have 1.5 million. And again, we break that up into the cash sales and the credit sales. And this is pretty common that most budgets will culminate in quarters, so 3 months at a time. Production budgets, which we know now come after the sales, are how many units the company needs to produce. Okay, then this will include the safety stock. In other words, they'll want to keep some extra inventory on hand in case they have a bullish year, or else we have other issues that come up. So this would be the inventory kept on hand in case higher demand, or in case demand is higher than predicted. Okay, so here's the units that we needed. This came from the sales budget. And with budgets, it's always going to be plus the desired ending inventory and then minus the beginning inventory. Okay, so previously when we did income statements, or we were accounting for inventory, it was plus the beginning minus the ending. But because we're looking forward, which is what a budget does, it predicts how many units we're going to need. We're going to plus the desired ending inventory and subtract the beginning. And this will then give us the units that we're going to need to produce. Okay, so going back here, if you look, this was step 1 and 2. Now step 3, we're going to subtract how much the company has from the total that they need. Okay, so what we had here is, first of all, step 1, the number of sales that we're going to have. 2, we added the desired ending inventory, and here it says that it's going to basically, we want 10%. So notice when you do these budgets, you can draw arrows to remind you where it's coming from. So 10% of the next month's is the desired ending inventory. We add those two together. This tells us the total amount we need. The beginning inventory tells us how much we already had, so we get to subtract this amount. And where's that come from? Well, they either give it to you, or you know that it's 10% of what is in the January beginning inventory. Okay. And then this is the number that you're going to produce. Okay, so as you're filling out the table, notice that, here we go, February, we said we're going to anticipate 20,000 cases when we sell. Here's 10% of the desired ending inventory, and then here's 10% of the beginning inventory, which is the desired ending inventory last month is the beginning inventory for this month. You can see again, there's a pattern that forms until you get to the quarter part of it. And the quarter of the desired ending inventory you just carry over. And then this beginning inventory here, it comes from the first month beginning inventory. Okay, so this is the desired ending inventory here, and this is the beginning inventory. So that's a production budget. Okay, and if you fill them out, it makes sense. We're anticipating how much we have to produce each month given the sales budget that we already calculated. All right, now probably one of the most complicated budgets is your direct material budget. So remember, there's a few steps in the process that will make life easier. And it says here we're going to need the quantity of direct material needed for the production. So we're going to need the number of units that are produced. That's why we had to do the production budget. Then we're going to do the desired ending inventory of that particular material. That will give us the total quantity we need. Then we're going to subtract the beginning inventory for the material. Again, remember, it's not the units. This will be the quantity of the direct material purchase. Okay, so look at step one. We're going to figure out the quantity of direct material needed for production. So we have to go and take 5 pounds per direct material, because in the last production budget, okay, if you remember, we said we needed 29,000 cases to be produced. It takes 5 pounds per case. And so this is the quantity of the direct material that needs to be obtained in order to do the production. Step two, we're going to add the ending inventory. So just like we did before, but now this time here, they're going to use 10% of the materials for the next month that's needed. So we have to go in and take a look and see what was the next month. Okay. And so it will look like this. All right, so notice we just carried these numbers over from the production budget. Step one, we multiplied each one by 5 because we want to get to this stage where we have the quantity of the direct material that's needed. Then we're going to subtract 10% of the quantity, or in this case, pounds for the next month. And then this is minus the beginning. Okay, where does this come from? The 14,500. You can go back up to the quantity. Notice we don't use these numbers up here at all because these are the units, and what we're talking about in the direct material budget is the pounds of material. But the 10% for the beginning inventory goes up here. You can also take 10% up here, or you can just bring it from the desired ending inventory last month is the beginning inventories. So you can either draw arrows going from here to here, or you can just realize that 10% of this equals this. Okay, and then you get to the end. Again, the desired ending inventory is the last month. The beginning inventory goes back here to January. And now the last step is, these are the pounds that you need. And if you multiply the cost per pound, now you have the total cost of the direct material that you're purchasing. And this is just adding them all up. This is adding up all the pounds. This is adding up all the costs. So direct material budgets, they're pretty tricky. And so we'll need to practice those several times. Now for this tape, we'll do one more. We'll do the direct labor budget. And it's similar to the direct materials. It's just what you don't have is you don't have inventory. So you don't have to make the adjustment for inventory. So we go back to the units we need to produce from the production budget times the number of hours. So that gives us our total hours required. And then, of course, instead of multiplying that by the cost of the material, we multiply it by the cost of the labor. And this will give us our total direct labor costs. Okay, so each case requires 0.05 hours. Okay, so they're obviously heavily automated. The labor is paid off at $22 an hour. Here's that 29,000 cases we know we need for January, times the 0.05 hours, which means a total of 450,000 hours. and then times the $22 means there's the amount direct labor costs. So in a table format, looks a little easier to follow. Again, units we need to produce, the amount of labor hours that go into producing one case, and it's not very much because it's just automated. So here's the total hours, here's the direct labor hour cost, and so this is the total direct labor hour cost. I should have said this cost per hour. And you do that for each one of these. Again, you don't have to adjust for inventory, which makes direct labor budget much easier. Okay, so before we go into the budgeted income statement, let's stop right now and we'll come back and finish it up in just a few minutes.